The Chinese government has been busy taking on the financial markets in 2024. It's been buying up stocks to prop up the Chinese stock market. It's been selling foreign currencies to prop up the RMB. The Chinese central bank just started selling bonds to burst what it calls a bond bubble. What does Beijing's new interventionism say about the state of the Chinese economy and governance system? Vladimir Putin can finally breathe a sigh of relief. His troops are starting to beat back Ukrainian forces in the Russian Kursk region. Moreover, since the start of August, Russian forces have taken control of more than 1,000 kilometers of territory in eastern Ukraine. My daily survey of global military conflict risk, conducted by Rewe, an online survey technology firm, shows that Zelensky's approval rating in Ukraine has collapsed, falling this week to the lowest level since the start of the war. After 2.5 years of gruesome fighting, victory seems within reach for Russia. Yet, I suspect Putin is not sleeping too well lately. The reason has more to do with oil, Russia's economic lifeline. Despite the announcement last week by OPEC Plus that it would postpone the planned increase in oil production, front-month Brent crude futures briefly fell below $70 this week. Relatively high oil price since the start of the Ukraine war has helped Russia pay for the war. If oil price were to suddenly return to the pre-Ukraine war range of $40 to $60 a barrel, this could be a big problem for Russia, even without the war. Ironically, Putin has his friend Xi Jinping to thank for the weak oil price. Chinese oil imports fell 7% in August, the fourth consecutive month of decline. China is the second largest oil consumer in the world, but China is also the biggest buyer of Russian oil, given Western sanctions on Russian oil exports. In July, Chinese oil imports from Russia fell 10%. What is driving the decline in Chinese oil demand? Should Putin be worried? One part of China's energy story is its transition to cleaner energy. Electric and hybrid vehicles in China have been growing so rapidly that they hit 50% of all car sales in July. This is probably why China's natural gas imports are still increasing, even as its crude oil imports are falling. But energy transition is a small part of the story. The bigger story is the deepening of the Chinese economic slowdown. Chinese car sales fell for the fifth straight month in August. This is despite the fact that drivers are eligible for a cash subsidy of as much as 20,000 yuan when trading in petrol-powered cars to buy new energy vehicles. Chinese consumer confidence, which was already depressed, fell further to hit its all-time low in July. As a result, Chinese households are saving rather than spending, with household deposits piling up. Meanwhile, the Chinese stock market is crashing. This is notwithstanding the tightening of rules against short sellers and high-frequency trading by Chinese regulators earlier this year. As a result, the Chinese stock market is now at a 6-year low. If the Chinese stock market is once again the worst performing stock market in the world, the Chinese real estate market is doing no better. 5 years into China's real estate crisis, there are no signs that the slump has turned a corner. Home sales and home prices are still falling, despite record low mortgage rates, despite a slew of measures introduced by Beijing in May to reduce down payment requirements, ease purchase requirements, and to ask local governments to purchase unsold properties for social housing. I said back in June that these measures were too small and too late to stabilize the crisis. The jury is still out, but I'm feeling increasingly confident that I will be proved right. There's growing evidence that Beijing's policy response to China's economic slowdown is not working. The million-dollar question is whether Beijing will be forced to bring out the big guns, or that we should expect the economic slowdown to deepen further. By big guns, of course, I mean quantitative easing or much bigger fiscal stimulus. Arguably, if China was going to roll out the big guns, it should have done so already. If it hadn't done so, it is likely because Beijing has constraints. China's primary deficit in 2024, fiscal deficit excluding interest payment, is estimated to reach 6.1% of GDP, the second highest among G20 countries, only behind Japan. China's total debt to GDP ratio, including both government and the private sector, is already at US level, and the highest for any country at the levels of China's economic development. If China is facing serious fiscal constraints, what about quantitative easing? After all, with close to zero inflation and depressed money supply growth, there is no obvious constraints when it comes to QE. To the contrary, QE will help bring down real interest rates that are clearly too high for China. It should be a no-brainer. Yet Beijing has clearly decided against going down this path. In fact, it has just decided to do the opposite of QE. Over the past week, China's central bank has been intervening in the bond market to drive up long-term interest rates. The central bank says that it is trying to burst a bond bubble. That this is what it thinks says to me that Beijing is completely behind the curve, that it is far too optimistic about China's economic outlook. Chinese bond investors apparently agree with me, as bond yields are falling despite bond selling by the central bank. What is happening in China reminds me of what happened in Japan in the 1990s that I wrote about in a study published by the International Monetary Fund 2 decades ago. Following the bursting of Japan's bubble, Japanese policymakers were in total denial of Japan's economic trouble. There was too much wishful thinking. As a result, Japanese policy response was reactive as opposed to proactive until a full-blown crisis erupted in 1998. To me, China's system of governance makes Chinese policymakers even more vulnerable to the ostrich problem. Chinese history is full of emperors surrounded by servile flatterers and sycophants who became oblivious to emerging troubles until it became too late. I'm starting to wonder if this is the reason behind China's current policy inertia. That nobody around Xi Jinping, China's 21st century emperor, wants to be the bearer of bad news. That people around him fear of being seen as critical of government policies, or even unpatriotic at a time of growing tension between China and the US. I hope I'm wrong, but if I'm right, then China is in serious trouble. On the opening day of China's recent third plenum, China's official Xinhua news agency published a 10,000-word article in which Xi Jinping was portrayed as a great reformer, worthy of comparison to China's former leader Deng Xiaoping, who initiated China's economic reforms and the opening up of the country in 1978. The fact that the article was later removed and is no longer accessible on the news agency's website is the only assurance that we have that dissenters may still have a voice. There are reports that the article triggered protests by some party elders. Whether this is true or not, I can't help think that China's political system, which has a tendency to perpetuate continuity, may be ill-equipped to solve China's current economic problems. Chinese export growth picked up over the summer, increasing by 9% in August. However, the rest of the economy remains stagnant. There are no signs of any pickup following the sharp slowdown in the second quarter. My prediction is that China will miss its 5% growth target this year, possibly by quite a bit. What about next year? There are many uncertainties, not least of all the outcome of the US election. But Fed rate cuts should provide more room for China to ease monetary policy without having to at least worry about the RMB. Nevertheless, I'm penciling just 4% GDP growth, with a risk of 3%. This will weigh on the prices of iron ore, copper, oil, and of course, the Australian dollar. In my view, commodities and commodity producers are a sell on rallies.